Welcome to today's webinar. We'll be speaking with our newest partner, LendKey, and we'll share a little bit more about what they have in store for credit unions here, and spend the majority of our time talking about how credit unions can leverage the services that LendKey provides to credit unions. So today's session is Reaching Younger Generations with LendKey Technologies. My name is Ben Herring. I am the Director of Partnerships here with CUCollaborate. I'm going to share a little bit about who we are and what we do on a daily basis, and then we'll jump right into learning more about what LendKey has to offer. So for anyone who does not know, CUCollaborate is now CUSO. I'm really excited about that. We really focus on data and analytics that help credit unions maximize their growth, impact, and performance. Specifically, we're really helping credit unions to adapt and thrive in this industry, in the financial world, and really abide by not only the mission of the credit union, but actually marrying up the mission of the credit union model to margin. And that looks like, for us, kind of two different lines of business. And so we build and evolve software. We also have a strong line of consulting. Our three main areas of focus are really driving greater impact through performance analytics with credit unions, helping them to leverage efficiencies within their organization through a data-driven approach. Ultimately, when it comes to growth, really focus on helping credit unions reach underserved communities. And so that might look like within your own membership and your field of membership, who you were designated to serve, or helping you to branch out and envision what does expansion look like. And so that kind of gets us to our third pillar, guiding expansion strategies and growth opportunities through a number of different areas of expertise. On the screen here, you'll see how those then extend out to the various different products and services that we extend to credit unions. So on the growth side of things, like I mentioned, currently the leading field of membership and charter expansion company in the credit union space. We do help credit unions envision what growth might look like through inorganic means, as well as through organic strategies such as seg group and business-to-business growth strategies, as well as getting into marketing and branding. We also help credit unions with their CDFI solutions, whether it's just helping them understand who they're serving and how to increase their lending to CDFI target markets, or doing the very hands-on work of CDFI certification, grant applications, etc. We do the same type of work with the Low-Income Designation and leverage our impact analytics to kind of guide our work in those areas. And then lastly, on performance, really looking at helping credit unions look at how they're standing up against current peers. We've been lately getting into a lot of branch strategy work and have been dipping our toes into helping credit unions with product development. And so with that, I'm actually going to take down my slides here and just share a little bit about what we have in store for you today. As mentioned, my role here at CUCollaborate is focused on partnerships. And what we do in that vein is look for organizations in the credit union space that can help our clients do the very tactical things that we're suggesting that they do. And so a lot of our work is strategic in nature. We suggest that a credit union reaches more of their younger population. Well, we don't necessarily get the hands-on work done with credit unions in that vein, but we look for partners that can help our clients do that. And so that kind of segues nicely into our relationship with LendKey. We've been in conversation with LendKey for many, many months now, and have found a really unique opportunity to help credit unions with some of their strategic goals by reaching, specifically in this case, what we'll talk about today is student members and folks who have gone to school. For the low-income designation, for example, credit unions can actually leverage student data to boost their percentages for the low-income designation. So put that in another way, all students, all current students, help a credit union reach their percentages for the low income designation. Any student helps you with your low income designation. So when we're looking for partners, we look for partners like LendKey that can help you reach deeper into those types of communities. And so really, really excited about this opportunity to work closely with Ryan and his team. The LendKey folks have been fantastic already. We're really excited to share more about the wonderful work that they do, as well as how credit unions can leverage LendKey to really to reach student borrowers and members. So with that, thanks for joining us today, Ryan. Really looking forward to learning more about LendKey today.
Ben, thank you for the intro. Great to be with you guys this afternoon. Certainly appreciate you carving out the time. Again, my name is Ryan Giffen. I am head of client success at LendKey Technologies. Been with the organization for about 9 years, and we are currently working with about 400 credit union partners in the education lending space. So I've got some materials here that I'll walk through with you. And Ben, if you would just confirm when this is coming through.
That looks great.
Looking good?
Great.
All right. So as Ben had noted, we're here to talk a little bit about education lending. And as we get into it, there's a couple of things I always like to start with as it relates to student loans, education lending, because I think there is a lot of confusion out there, especially as we're approaching new clients, prospects that we haven't talked to about the asset classes before. I think it's important to really differentiate between federal student loans and private student loans. And I'm sure, as you guys have heard over the past couple of years, federal student loans have been in the news pretty regularly. Talks of loan forgiveness, payment pauses, high delinquencies. All of that information is true, but that's not what we're doing. Okay, so our loans are private student loans. They are very similar to what you're doing on a traditional consumer loan product, right? We are underwriting these using FICOs and DTIs. These are not needs-based loans that are being offered by the federal government. To give you a little bit more comfort, credit unions have actually been offering private student loans for almost 2 decades. Right now, there is about $7 billion or so of student loan assets on credit union balance sheets as of the end of 2024. So your peers are out there doing it, and it very much is serving a need. We were just at the GAC conference in Washington last week, and there's a ton of news coming out, especially related to the Department of Education and some cuts that are happening right there, that are happening right now. And unfortunately, these are going to impact your members. So, we really want to make sure that we're promoting the ability to help your student borrowers and their families achieve higher education. And it's becoming more and more difficult. Unfortunately, the cost of higher education is only going up. Over the past decade, we've seen it only go in one direction, and that includes, times of very low enrollment or lighter enrollment during COVID. But the price only continues to go up, so it's making it more challenging for your members to be able to afford it. Also, we're starting to see reductions in budgets for Pell Grants. So in 2026, the Pell Grants are going to have about a $2.7 billion budget shortfall. The reason for this is we're starting to see a surge in applications for Pell Grants. However, the numbers just aren't there. And to couple that, back in 1970, a Pell Grant was able to pretty much cover the cost of about 75% of an education at a 4-year school. Right now, it's less than 25%. We're also seeing a lot of some of these DEI scholarships and grants be put on pause, shelved entirely. So those are not going to be available for members in your community going forward. So again, very real need to help out borrowers at this time. But the good news is, despite these challenges, our credit unions are in a good position to help members achieve higher education, as well as set them up for success post-graduation. So, one of the things that we want to make sure everybody understands is, there's a pretty big lifetime earning power gap between a graduate and a college grad. And for those that are able to achieve a college graduate or college degree, that lifetime earning potential is upwards of 1.2 million. And it only increases, if they get further advanced degrees. So it is certainly setting them up for future success. Obviously, you want to build strong communities within your membership base and your backyard, and helping your members achieve higher education certainly does that. The other thing that I tell you is, you're getting in front of these members and their families in a time of need. So when you think about saving for college, getting your FAFSA, your government aid, as well as any type of scholarships or grants that it's available, there's still a gap that exists. College is expensive. A typical private student loan is going to be about $12,000, right? That's money per year that they just haven't saved up for, or they haven't been able to get in the form of scholarship or grant. So you are helping that family in a time of need by being able to finance that education, and they remember it, right? And if you get in front of them during their freshman year, oftentimes they're going to come back, right? They're going to come back to borrow their sophomore, junior, and senior year. And then, hopefully post-graduation, they're gainfully employed and they're looking to you for additional products and services. So again, I think it's a great opportunity to get in front of borrowers and families very early in their credit journey. So why LendKey? Well, we've been at this since 2009, right? And I think one of the things that's important to understand is, as we're talking to our partners and our prospects, we do not expect anybody to be student lending experts. That's our job, right? So we've got all of the in-house expertise to really help you stand up this program, get into an asset class that, you may never have been in before, you may not be very familiar with. A very, very light lift in terms of implementation. We can generally do this within 4 to 6 weeks of starting our conversations. And I think the upside lifetime value that it provides to credit unions is really remarkable. So again, as we kind of wrap up and you guys have questions for us, more than happy to answer anything related to LendKey and how we work with our lending partners. So as Ben mentioned, we just established the relationship here. We announced it last week at GAC, which is fantastic. We've had a chance to get to know each other. The firms have had a chance to get to know each other over the past couple of months, and very excited about the opportunity to work with the CUCollaborate client base and introduce some of our products and solutions that are going to be most impactful to low-income designation and potentially your CDFI initiatives as well. So when we think about education lending, there's really two unique product sets. It's the private student loans as well as student refinance. So on the private student loans, what you're thinking about here is borrowers that are actively enrolled in college or university, and they are borrowing for their undergrad or their graduate degrees. Like I noted earlier, the average loan size here is going to be about $12,000 per year, right? That's what we're seeing throughout the LendKey portfolio. And these borrowers are often going to serialize, meaning they're going to come back year after year until they graduate. One other thing that I think is important to call out, especially on the in-school product, is, again, these are 18, 19, 20-year-old kids. They don't have a credit profile. They don't really have much trade line history. So 94% of these loans are co-signed, right? So it's generally mom and dad or a guardian on there. So in terms of credit risk, you're not putting it all on that young person, but generally a parent or guardian is going to be attached to these loans until graduation. The other benefit is it is helping these young folks build a credit profile. So we are reporting these loans to the bureaus. They are set up for a very manageable payment. So they can either choose to do an interest-only payment while they're in school, or they can just do a standard $25 flat payment. But it gets them in the right behavior of making a payment on a debt obligation every month. And by the time they're coming out of school, 3-4 years later, they've got an established credit profile, and that's going to help them as they enter the workforce, try to get that first apartment, get that first auto loan. So really is helping them along the way. Now, upon graduation, what we typically see happen is throughout their college career, borrowers have taken out both federal and private debt to finance that education. And once they graduate and call it May or June, they're going to have this 6-month grace period. During that grace period, they're leaving school, they're setting up their new lives in a new city. They've become gainfully employed. And at that 6-month mark, the principal and interest payments start to begin, right? All those grace periods are over with. The deferred payments are over with, and the principal and interest really starts to hit. And it all happens around the same time, call it September, October, November. So it's very much top of mind for these borrowers to consider a refinancing solution, put everything under one manageable payment. And that is a product that we're offering as well. A little bit of a different profile, right? They're no longer 19 or 20. We're typically seeing an average age of 24, 25. They are gainfully employed. Many of them are able to qualify on their own, but we still see about 50% of the student loan refinance asset class is going to be co-signed. Just a few other facts and figures as it relates to the in-school student loans. You know, as I mentioned, cost only continues to increase over the years. Right now, this is a $130 billion market for private student loans. Of that $130 billion, as I noted, $7 billion is held by credit unions. So $7 billion in private student loans amongst the credit unions. You know, the major players out there are going to be Sallie Mae. They're really dominating the history or the industry, but there is certainly opportunity for more of our credit union partners to play as well. Now, every year, about $5 billion is going to be borrowed in private student loans, and that's representing over 7.5% of all U.S. student loans. The growth rate here has outpaced auto, credit card, and mortgages. And then the final bullet here is about 20% of the folks that take out a student loan with a financial institution, they're going to be sticking around for an average age or for an average length of about 14 years. So it gives you quite a big runway to deepen the relationship with these members, right, as they continue to move along their credit journey. On the student refi side, you know, I think over the past few years, the number $1.7 trillion in student loan debt has been in the papers quite a bit. So that number is probably not a surprise. Right now, 20% of credit union members are holding on to student loan debt, and that's about $340 billion across our industry. You know, the other thing that I think is important to call out is student loan debt is not just in the 20-something age group. Just under half of the balances are held by borrowers that are age 40 and over, right? So they need help as well. And I think it's important to recognize that, you know, these folks are still relatively early. They may need help buying homes, and if they can refinance some of their debt to put themselves in a better position to do that, you know, the credit unions can be there to help out. Average balance for the student refi portfolio, $45,000. And we do continue to expect to see this to increase as far as demand. We've been in a high rate environment for the past, 3-4 years at this point. But as rates do look to come down, maybe in the back half of 25, early 26, we're going to start to see much more demand on the student refi side to have folks put themselves in a better financial position. So how does LendKey really support our credit union partners? Since 2009, we've really been responsible for the majority of the acquisition, credit decisioning, loan origination. We service all of this, and then we've got some interesting liquidity management tools at your disposal as well. So as far as the consumer acquisition, we partner with our credit unions to provide them a lender landing page, right, where they'll get a hyperlink that they can put on their websites promoting both in-school and student refi. Additionally, LendKey is sending new members to our credit union partners as well. So we'll have your field of membership, we'll have your zip code information, and if one of our marketing channels gets somebody that would be eligible for your footprint, we're able to send those to you as well as a new member. We have worked with, like I said, about 400 credit unions over the past 15 years to develop really, really strong credit decisioning. So we've got a great history there. Happy to share performance reports with you guys if you are interested in that as well. We handle the entire loan origination process. You'll have full access to an electronic loan jacket that you can go and review information. You'll have all of the borrower vitals in there, credit reports, DTI, their driver's license information. So that's fully accessible to all of our credit union partners. And I think the other important thing that I noted at the top of the call, we do not expect our credit unions to be student loan experts. That's our job. So when it comes to servicing, there are definitely some unique nuances to managing student loan borrowers, especially those that are in school and dealing with the certification process and coming back for subsequent years. So we handle all of that on behalf of our partner credit unions. And then finally, from a liquidity management standpoint, we've built out a network of lenders. So, hundreds of lenders are working with us in these programs. And I'll forward to the next screen just to help you guys understand what that looks like. But as we partner, hundreds of credit unions together, it does offer some pretty unique benefits. From a liquidity management standpoint, you're not required to full fund each of these loans. If you want to hold just a 10% stake and offload 90% to share that risk amongst the network, that's completely available to you. You don't have to be in both PSL, the in-school, and the refi asset class. You can flex between either one of those, or you can certainly take those on. You also have the ability to participate in loans that are outside of your footprint. So if that's going to be helpful for LID or CDFI, you're able to buy loans or buy loan participations in different markets as well. And then if you're not in these asset classes, the returns on these asset classes, I think, are pretty favorable. And again, I think the options that it makes available to you guys for lifetime value and deepening the relationships with your members and their families is pretty significant as well. So Ben, I think that covers most of our prepared materials, but hopefully you guys get a good understanding of what we're able to offer in terms of education lending, and I hope you're not scared by it. Hopefully we've dispelled some of the misconceptions out there between federal and private. But I'll close with this. There is a very real need within the membership base to help finance that higher education, and we'd love to partner with you guys if that's something you're interested in.
Thanks, Ryan. Yeah, so we'd really like to open it up to questions, comments, any thoughts that you all had as you're taking in the information that Ryan has extended to us regarding what LendKey does and how they work with credit unions to reach student borrowers. I don't have any questions coming through quite yet, but definitely had kind of some thoughts as you were going through the presentation here. I really appreciate you bringing up some of the very relevant, timely shifts in or uncertainty around, kind of some of the borrower needs. So transitioning, it seems like there's a pretty fluid mechanism to getting consumers and new members into the channel and to credit unions. What does it look like on, the credit union side, and how does LendKey help for marketing this product out via their channels? Do you guys help with that?
We do, yeah. So great question. There's a couple of ways that we partner with our credit unions, and generally we're going to set up our implementations call, and we're going to include the marketing teams as a part of that series of calls. And what we're going to do is we're going to walk through how to promote this on your websites, building out education landing pages, and then showcasing how the lender landing pages that I referenced for both the in-school program as well as the student refi program. So we'll kind of help you build out a flow to make sure that it's front and center with your membership base. The other thing is there is, very unique times throughout the calendar year when you really want to promote this. So for example, on the in-school program, June 1 through Labor Day, right? That's what we consider to be peak season. That's where everybody is applying for financial aid. They have to have their funds at the school before Labor Day, before they show up on campus. So we want to make sure that, the credit unions are really putting this front and center on banner ads and newsletters, and we've got a whole tool set to help out with that. We've also got a lot of collateral available to be utilized on your social channels. We've got in-branch material. We do a series of webinars every spring. We're actually kicking off in about 2 weeks with our first webinar, where we invite all of our credit union partners to join us for the upcoming season. So I'd say we're not short on resources as it relates to promoting education lending.
We do have a question coming through the Q&A section, and I think this kind of goes into, you guys work with you said, I think about like 400 credit unions throughout the country. But I think there's always kind of like this perception around these borrowers, and I think it would be helpful to talk a little bit about the lending side. And so this question here is, do you know what the delinquency rate is that you're seeing with your credit union partners? Do you have any of that data available?
Yeah, I can tell you LendKey's delinquency rate on our entire portfolio, which we've serviced just under 2 billion, is less than 1%. And that's on or in-school student loan. On student loan refinance, it's at about 0.7%. So they're performing quite well.
And then this is another question that's coming through the chat. As prospective members, consumers are coming through your channel, are they becoming members? Is this technically a form of indirect lending, or how would you describe that to a credit union?
Yeah, so a couple of ways that this can work. We are able to send new members if we have your field of membership, your zip code information, and we get an applicant who comes into one of our channels. And if one of our lending partners is in that footprint, we will deliver that as a new member. The other side of the model in our participation network is you've got the ability to buy 10% stakes of loans that are originated by other credit unions throughout the country. So those may be looked at as a little bit more of an indirect model where you're participating in a student loan asset, but it's not your member. The benefit there is you get some of that geographic risk diversification as well as just risk mitigation for not, having to full fund these loans.
Yeah, I think the important part to point out here, especially as you're thinking about your credit union strategies, if you're really focused on student members, let's say, to help with your low-income designation, you're really going to want to make sure that you're memberizing the consumers coming through. And so when you're exploring this as an option, having a direct path to membership is going to be critical to hit your low-income designation strategies. On the other side of this, if you're looking to diversify your portfolio through the purchase of these loans, we can actually also help your credit union look at this in a perspective of, does this help us with our CDFI certification status? So we're working also with LendKey around enriching their data so that you would know which loans might help you with your CDFI certification status as well. So really, if those are strategic initiatives of your credit union, please definitely be open about that. I'm sure that the LendKey folks will ask you as well. We just want to make sure that we're helping you in hitting your goals for the foreseeable future. Let's see here. I think this is a really good one to talk about because I think there's some common misconceptions that come up with this too. But could you talk about what are the types of schools, or what are the types of things that you will lend to, the types of schools that you'll lend to?
Yeah, so we do have what we call an eligible school list, and not all schools are the same. So, one of the things that we built out in the early days for the in-school program was this eligibility criteria. And effectively at a high level, we're looking at Title IV schools, so schools that receive federal funds. And we're also looking at cohort default rates. And a cohort default rate is going to be published by the Department of Education, and they're taking a look at a 3-year look back from borrowers that have graduated from that school and borrowed funds. And they're looking at what percentage of those borrowers have gone delinquent at that 3-year mark. So we've got that established threshold, and we're more than happy to share that with you if you guys want to connect offline. But yes, not every school is eligible. It is important that the performance and the likelihood of folks being able to find employment after graduation is a key factor.
This is more on the kind of the logistical side, or the operational side. Another question coming through the Q&A section. So a two-parter. First, does LendKey service the loans, or who services the loans? Do you have options there? And then secondly, I'm assuming, I think you guys have a call center, and is that in-house, or how does that run?
Yeah, absolutely. So first part, LendKey services the loans. These are unique asset classes, right? Especially for in-school student loans and dealing with the school and the certification process and potentially 2 to 3 disbursements over the course of an academic year. That is something that we take responsibility for. And as it relates to the contact center, yes, our contact center is located just north of Cincinnati, Ohio, in Blue Ash, and that's fully stocked with origination and servicing agents, as well as our collections team.
We're throwing all sorts of stuff at you today, Ryan, so appreciate you kind of rolling with punches here.
I appreciate the engagement. That's great.
All right. Well, we certainly don't need to take a full hour here today just for the sake of taking up an hour, and always happy to give you guys back some time in your day. Any other questions, comments, considerations? As I'm waiting for any final questions to come through, I'm going to go ahead and put my direct email in the chat. Ryan, if you don't mind sending over any contact information in the chat if someone wants to reach out initially.
Absolutely.
And then looks like we might have another question coming through here. Oh yeah, this is great. Okay. Question coming through. Credit union doesn't have a student loan program. So from a risk basis, there's not much of an appetite at the credit union for this. So do you have a referral program or a way to kind of like offer this at the credit union without having it run through the credit union?
Yeah, we can absolutely help out with that. I'd love to understand, first of all, why the risk appetite might not be there, and just to help you guys realize the upside in the relationship, the lifetime value of these relationships with these members. But absolutely, we've got solutions we can make available there too.
Right. So as we're wrapping up, we will be sending out a follow-up to today's webinar. It'll be in your inbox tomorrow morning. That will include slides from today's presentation from Ryan, as well as a recording of our webinar if you would like to share out to your other teammates or others who might be interested in learning more about what LendKey has to offer. And we'll also provide contact information and a way to schedule follow-up meeting if you'd like to learn more and have a deeper conversation as it pertains to how to bring in LendKey services to your credit union. So with that, I don't think I have any other questions or comments. Ryan, do you want to leave us with just maybe a couple comments on your side?
Yeah, again, appreciate the time. I know that education lending does have a lot of confusion around it, so hopefully we're able to dispel some of that. As a reminder, there's a very real need, right, for your membership and their families to pursue higher education. It's going to make for a stronger community in your backyards, and you're definitely putting a smile on their faces. So if there's anything we can do to be helpful, please do reach out.
Thanks again, Ryan. Thanks everyone for joining us today. Happy to give you some time back in your day. Don't hesitate to reach out. We're looking forward to working with you into the future. Thanks, everyone.
Take care.